everything else that's not required and it's not a personal perk is an investment in your business.
Okay.
And every investment should either return time or money back to you, the business owner, or to the business. So if it's not returning time or money, then why are we still paying it? And I get it. I get this all the time, but it's marketing and marketing takes time. And that's true. But marketing also needs a deadline and it needs a point where we say, is this working or not?
Hey there, CEOs. Welcome to the Wedding Pro CEO podcast. I'm your host, Brandee, and my mission every single week on this podcast is to help you, the wedding industry entrepreneur, to build a profitable wedding business that you actually love. On today's show, I am talking with fractional CFO Danielle Hendon, and we're talking all about the 3 red flags that every business owner must know inside their business. On this show, we often talk about the profit and loss and what to look for and how to run it, but we rarely talk about the balance sheet. And so I had a lot of golden nuggets in this episode as well, and it was really fun to learn right alongside you. You guys, you're going to want a notebook for this episode, and I cannot wait for you to be able to just run these reports right alongside us or pull your balance sheet and your profit and loss and take a look at what yours looks like in comparison to this episode. I know that you are going to love it, so let's get right in. Danielle, I am so excited that we are getting to chat today. We are talking all about money, which is one of my favorite topics. I know our listeners are loving this topic as well. Even if they're listening and they're like, I'm still afraid of money. It still scares me. It makes me have hives. I think I'm hopefully on this show starting to break down some of those barriers so that every time we talk about it a little bit more, it's yes, tell me one more thing to master my money. So I'm thrilled that you're here and that you can dig into this topic with us a little bit more. So thanks for being here.
Thank you so much for having me. I think money is one of those things, especially women in business. We want to put our head in the sand and hope it all goes well. I will never forget, I'm a swim mom. So one of the other swim moms on our team, she runs a business, and I would start talking about budgets and she's like, you're making me sweat. We can't do this.
Yes. I feel like that word budget, it has a negative connotation to it, right? But I always like to tell people that I feel like a budget gives me freedom because it helps me to see that I actually do have money to spend and I don't have to feel guilty about it. Do you feel the same way that it gives you that freedom?
Definitely. It's not just the freedom, but it's also, I tell people all the time, your budget's a roadmap. It's helping you get where you want to go. And so many of us love visualizing and dreaming and casting that big vision of where we want to go, but how to get there can be a little gray. So I like
Yes.
to pin it down in the budget and say, okay, how do we get there? And then you know exactly what you need to do and you know it's going to happen because you're doing the things.
That's so good. Yes, it's exactly a roadmap. It tells you the health of your business, what you can do. It gives you just that, yes, that check mark. Yes, I can do this and I feel really good about it, even though your bank account may be low at the moment. I'm jumping ahead of myself, Danielle. So tell us, I'm like, let's just dig into it. But why don't you tell us a little bit about what you do and how you got into money now?
Yeah, so I am a CPA. I went to school, I got my master's in accounting, and like most accountants out of school, I went into public accounting because that's what they tell you to do. And I'll be honest, I loved it, but then I started a family and I realized you can't raise a newborn and work 80 hours a week. It
Mm,
just doesn't work.
mhm.
So I left public accounting and I went into the corporate industry side of things.
Okay.
I'm in the Houston area, so a lot of my experience was in oil and gas, which meant I landed in oil and gas down here.
Okay.
And but again, I loved everything I did when I landed in industry. I love numbers. I love getting to play with the numbers. It's like one giant puzzle to me. And that satisfaction you get when you put that final piece of the puzzle in, love it. I love everything about it. But the oil and gas company I was with went through bankruptcy a few years ago. I guess it's almost 5 or 6 years now. Back in
Wow.
2018,
Okay.
they came out the other side and the bankers started slicing and dicing and selling everything off. And then the pandemic hit.
Mm.
And for me, the pandemic was kind of a double-edged sword. We knew the company was going to close. We had gone from being a $1 billion business to, I think by the time I was let go, it was 20 people. And it was also the opportunity for what I will admit is a workaholic mom, because when you love what you do a lot of it, to get a completely different perspective of parenting.
Okay.
I was swim mom. I was get 'em to school mom. I got to know the teachers and the friends and the coaches, and I realized I didn't want to give that up. So
Hmm.
as much as I knew I could jump back into corporate, I could be downtown again, there had to be a better way to do what I love, but also be there for the people I love most.
Yes.
And I was blessed with a friend who runs her own business that introduced me to another fractional CFO
Okay.
who just told me what she does. And I was like, wait, so there's a world where I can do the really fun parts of accounting for all these small business owners that just aren't familiar with it. The things
Mhm.
that make big business bigger, they apply to small business just the same way. But you have to know how to understand it and talk it and teach it and do it without sounding like your traditional accountant that speaks on top of everybody.
Yes, that's so good. So some of our listeners may be familiar, but for anybody who isn't, can you tell us what a fractional CFO is?
Yeah, so there's actually a couple different types. I
Okay.
network with a lot of fractional CFOs because we can pass each other business. We don't all do the same thing all the time. Some fractional CFOs that are very funding based, they want to help you get the capital, get the loans, get the money in the door, and they focus on building the financial statements that are going to get you the money you need. And
Okay.
then you have what I like to call operational CFOs, where we're kind of a mix of a controller and a CFO, and we're there to help you build a budget and forecast the cash flow and get into the strategy of the forward looking aspects of finance. And that's where I sit, is in kind of that operational CFO. We focus on taking small business owners from just getting their books done for taxes to
Okay.
actually using those numbers to build and grow their business through a budget and a cash flow forecast.
Very cool. Okay. I had no idea. I thought all fractional CFOs did the same thing. So that's super helpful to understand. And I do love that this has become popular, would you say, in the last 5 years since really the pandemic, I think,
I think
right?
so, and I feel like it makes my heart happy in
Hmm.
seeing how many small business owners now have access to a level of information that was honestly previously just corporate.
Yeah. Yeah, 100%. Because as a small business owner, it's impossible to understand. We need to understand our craft, right? And how to build a team and how to make money. But then really being able to bring an expert into your business that you're not having to pay this six-figure salary that can really help you to understand and master cash flow management and asset management and things like that. So, speaking of cash flow management, I'm so excited to dig into this a little bit. But one of the biggest things in the wedding industry, you're in Houston. So your wedding pros in the Texas area have a very similar season to mine because I'm in Florida. So that's super busy spring, super busy fall, and tumbleweeds all summer,
It's
which
too hot.
it's too dang hot. That's exactly right. People should not have weddings in the summer. So there's that. But let's talk about that cash flow management a little bit because no matter where you are in the country, you have a high season and a low season. The blessing of being in like Texas and Florida, we have a much longer season. But for those 3 to 4 months, there's no weddings. It can become very difficult to manage cash flow. I am a wedding pro just like you. So, like, I still have to manage summer. And just because your revenue gets bigger does not necessarily mean your problems go away. Your problems just get bigger because your payroll gets bigger. I remember what it feels like to not understand how to manage off season. Now, I've worked with people like Danielle to help me understand how to manage off season. So now we know how much it costs us every single month to run our business. But the number of summers that I can remember either not being able to take a paycheck from my business or feeling just like an elephant was sitting on my chest because I did not know how we were going to get to October. I know that feeling. So, Danielle, can you talk a little bit about that, about how to manage cash flow when you have such volatility?
So the first step is knowing your cycle. You really have to know what is your busy season and what is your down season. And if you have two busy seasons in finance, we usually look at a year.
Okay.
And for a lot of businesses that are not cyclical, like the wedding industry, that's going to be January through December.
Yeah.
But when you are in the wedding industry and you have a cyclical season, I highly recommend you look at your 12 months in that cycle. When does the busy start and go all the way through when it starts again the next time? And that probably is not going to look like January through December.
That's right.
And making sure you really understand what the busy season is, what the down season is, And then the next step is to look at your revenue and your expenses.
Mm.
Every business owner I know could spout off revenue numbers real easy. Not so many can sit down and spout off those expense numbers.
You're 100% right.
So you know the revenue, you know when it's coming in, but now take a look at those expenses. And what I do with my clients is we take a year's worth of expenses and go through all of them, figure out which ones are recurring. That means they're happening over and over again, whether it's monthly, quarterly, yearly, and
Okay.
when do they happen?
Mhm.
Which ones are random? Like you were like, oh, that looked really good. Let me buy that. But
Yeah.
maybe it wasn't necessary. Maybe it was. And then, identifying what we call frequency, that's the first part. The other part that I do with all of my clients, and I love this, is going through and bucketing them as one of three things. You either have required expenses, the things you
Okay.
absolutely have to pay to keep the lights on, keep the business open. I don't know a single business owner these days that can work without a cell phone and internet.
This is true. This is true.
So the bills that have to be paid for your business to exist, those are required. Then you have what I like to call the personal perks, the
Okay.
things your tax CPA or tax EA has told you can run through the business, but they don't necessarily add value to the business. They're adding value to you, the business owner.
Mm,
The car that you might have on the business,
okay.
or the house cleaner if you're working from home.
Yeah.
So those things, we call them personal perks. And when we're looking at overall numbers, I usually include those in that owner's compensation bucket. Even though it's going through the business, it's helping you personally
Yep.
as the owner.
Okay.
The last category and the most important is everything else that's not required and it's not a personal perk is an investment in your business. And
Okay.
every investment should either return time or
Mm.
money back to you, the business owner, or to the business. So if it's not returning time or money, then why are we still paying it? And I get it. I get this all the time, but it's marketing and marketing takes time. And that's true.
Mhm.
But marketing also needs a deadline and it needs a point where we say, is this working or not?
That's so good. I love that because I love you talking about owner's perks. Those are important, right? Not required, but important. But also that everything should return time or money. And it's so interesting that you said that so many people don't know their expenses. That's 1,000% true. Yes, all of us can spout off our revenue at any given point because that's what we're focused on. But the
Mhm.
reason that I think so many people in the wedding industry don't have money left over at the end of the month is because they have no idea what their expenses actually are. So an up month feels like so exciting, but really in reality, it might be the only month you actually got to break even,
Yes.
right? And so we need to understand really what those expenses are. So once we understand what those expenses are, what are some tips or strategies that we can use to help when we have months where we aren't going to bring in enough money?
So the next step is taking those required costs and the frequency of those costs and figuring out what is your baseline? What
Mm,
absolutely has to be paid every month in those down months?
okay.
And some of that may be investments. You're going to pull some of those I would never want to give up my social media even if a month was like you've got it. There's
Yeah.
things you have to keep going or you lose steam, you lose traction. What is that baseline expense total for you in a month? Not, hey, we've got, and this is where I want to make sure we're separating. When you know revenue, you're going to have revenue generating expenses that are
Mhm.
related to revenue. If you've got to get an assistant to help with the weddings, that is a revenue generating
Mm.
expense. It's not part of that baseline. The baseline has to happen even if $0 are coming in the door.
I love that. Yes, that's so true. But here's the thing that I see a lot in the wedding industry, Danielle, and you can tell me if you see this too, is that I consider having a team a revenue generating expense. You just talked about even having an assistant, right? And so often, what happens in the wedding industry is that when your bank account looks low because you don't have an understanding of your cash flow, you just see your bank account when you're booking weddings, you start to take them on yourself because you're like, I'm free, but you're not free. You're not free. You're actually really, really expensive. You take that wedding on yourself instead of giving it to a team member because you're like, well, I have to pay the team member 30%, but I'm free. And in reality, what that ends up happening is that now you, as the business owner, are being taken away from all of these ways that you keep your business generating revenue and functioning well because you're so buried under weddings because you were afraid to pay someone else to do it. So I love that you describe that as a revenue generating expense that you just paid to do that wedding is generating revenue for your business, right?
Yes.
So
And you have
important.
to remember that as the business owner, if you are so busy working in the business, how
Yes.
much money are you giving up that you could have made because you weren't working on it?
Yes,
You're not free.
100%. You're not free. And I want to just sit on that for a second. I know because this is so, so important. And I vividly have like pictures of a few of the people in my accelerator group that I'm like, have just had this epiphany. And they're like, I'm making so much more money. And I'm like, I know you are because the unlock to scaling is understanding that you're not free. Because
Mhm.
and I think I'm so passionate about that because I did it for so long. Like Danielle, I've had my business for 16 years. I sat in this not good mental state of running my business of where I considered that the more I would take the weddings first and only the overflow that I couldn't handle would go to the team, which ended up with me in 1 year handling 42 weddings myself, plus
Ouch.
having a team. Yeah, it was crazy. And that was the year I broke and was like, I would rather just shut this whole thing down. Like this isn't what I wanted. This is a nightmare. And it's not the dream, that's for sure. And when I started to understand that when I looked at my team, instead of thinking about them costing me 30%, when I started thinking about it more like, but I'm making 70%, not me personally, but the business, right? And so that's actually going to help us to generate more revenue because I can focus on booking more weddings, mentoring a team. Like you just start to scale very, very quickly. And
Mhm.
it's such a cool feeling when you have this unlock that you are not free. So I love that you said that. I love that you said that. Okay, so I want to talk about your red flags. You were talking about the top 3 financial red flags for service business owners. So tell us a little bit about that.
Yeah, so this is completely separate from the feast or famine cash flow conversation, but when you are looking at your numbers, and I hope you're looking at your numbers,
Yes.
there are 2 different financial statements that a bookkeeper is gonna give you. One
Okay.
of them is your balance sheet, and
Okay.
that basically represents what your business is worth. It's all of your assets and liabilities. What does your business own and what does your business owe? And it shows what your business is worth. So that's your balance sheet. And then you've got your income statement or your profit and loss. You'll hear it termed either way. And that's what shows your revenue and your expenses. And at the end of the very bottom of it, it's going to show your net income. One of the financial red flags that I see a lot is when you look at that balance sheet and you have a significant amount of debt. A lot of people look at their P&L, they look at their income statement, but they don't
Yes.
necessarily look at their balance sheet. The payments you make on your debt also aren't going to show on your P&L and your income statement. They
True.
only show on your balance sheet and they show
Yes.
on your bank account. So a lot of times people will be forecasting their cash flow mentally and
Okay.
thinking through how much money they think they're going to have and not realizing what that debt is doing to their cash flow. The other part of that that's a red flag if you have a lot of debt on your balance sheet, and I don't want anybody to feel bad if they do.
Mhm.
So many people took on those idle loans. So many people took like life happened in these last few years and debt is normal, but there is such a thing as good debt and bad debt.
Yes.
And if you are sitting in a place, and when I say debt, I also mean those credit cards that don't get paid off, or if you have a line of credit that you've drawn on and haven't been able to pay down,
Okay.
along with things like the idle loans or what we in finance you call a term loan, something that's a fixed loan like your car note. So having a significant amount of debt that outweighs the rest of your balance sheet. Usually, as a CFO tells me that we have probably been in a position where we couldn't pay ourselves
Mhm.
and had to go leverage debt to do it. Because at the end of the day, even if you think your business doesn't have any bills in those down months, you personally still have bills in those down months and you're
Yeah.
going to need money for them.
Yes.
So, high debt is one of the number one red flags. There
Okay.
are a couple of ways to deal with it. Credit cards are what I would call the worst type of debt.
Okay.
They are usually unintentional spending.
Mhm.
There, we just had to do it and we couldn't pay it off.
Mhm.
So, getting to a place where we pay off those credit cards or can roll them into a line of credit or a term loan.
Oh,
Not
okay.
as easy right now with the banks being a little tighter, but that is going to give you a better interest rate and a plan to pay it off versus
Yes.
just letting it go and go. Debt isn't always bad though. If
Mhm.
you have intentional debt, which usually does exist in the form of a term loan or a line of credit draw that you took out for a new employee and put back once they're up to speed, those can be the kind of things that build your business. So,
Okay.
knowing what the different types of debt are and how they affect your balance sheet, how they affect your cash flow, and
Mhm.
what that looks like, that's one of the number one red flags.
So good. Okay. Good debt and bad debt has come up a lot on this show. It's come up a lot in my accelerator group. And I think because it's becoming also a hot topic on the internet, right? Like TikTok, Instagram. There's so many people that are talking about get rid of Dave Ramsey and let's talk about good debt versus bad debt because there are both. And so I love that you just brought up the balance sheet. Hopefully, if you're listening to this show, you review your P&L every single month because I preach it like that's my job. And so I want you to be reviewing your P&L. But we haven't talked a lot about the balance sheet and understanding how much debt your business has and which of those debts may be good or bad. Can we talk for just a second? I think we all know that credit card debt is bad debt, right? I would say it's a rare circumstance that credit card debt's a good debt, right? The EIDL loans, a lot of people have them, right? And that was kind of like you said, a necessity of life. But I would love to talk about the equity line or the
The line of credit.
thank you, line of credit. And I do actually encourage my students often to have a line of credit, whether they need it now, actually get it before you need it, right?
Yes.
I think one of the things going back a little bit to our conversation of cash flow management with having high season and low season, it's a fact of life that you are going to have a high season and a low season. So can you talk just a little bit about how you can use a line of credit with good intention and how that could work for you? Because I actually think a lot of people do not have lines of credit in this industry.
Oh my goodness, that amazes me because a line of credit, even outside of the wedding industry where
Mhm.
they're not as cyclical, it is one of the first things I recommend to my clients because it's a safety net. It is the best safety net you can give yourself. You
Yeah.
don't have to touch it if you don't need it, but it's there when you do.
And so with a line of credit too, shockingly, I will tell you, I work with powerhouses in the wedding industry. Like my students are typically, they've well crossed into the six figure. And I can tell you of only one of my students that I know that has a line of credit or had before we started working together because I'm like, get a line of credit, get a line of credit. I think one of the biggest benefits that I see in it is what you just shared, which is like you've got it and you really only have to use it if you need it. One of the things that's interesting as well about a line of credit is you don't pay interest on it if you're not using it. Is that right?
That's correct.
So you only pay interest on what you've drawn down. So let's say you have a $50,000 line of credit, but you've only used 10,000 of it to get you through low season, right?
Yep.
And then you can pay that back in high season, but you're only paying interest on the 10 that you've drawn down.
Yes. And what I love about that is it helps people get from ideally, when it comes to feast or famine and cash flow, we wanna have money in savings. We wanna
Yes.
get to a point where we can pull from savings for that low season.
Mhm.
But until
Mhm.
you can borrow from next season by using your line of credit, and
Yeah.
it also gives you a little bit of that push to work your
Yes.
butt off to get that, and then on top of it in your next season.
Yes, that's so good. And I think when you've got history, right? When you can let your numbers tell you a story. So you can see that in the last 3 years, you've done X revenue during engagement season or you do X revenue in your business. You know what's coming. So to borrow against it to your equity line isn't really much of a risk because you know it's coming. I actually still remember sitting in my CPA's office. I was a baby business owner. And well, I was probably 6 years in when she said, you need to get a line of credit. And I was just, we were so against debt. We were so anti debt. And I was just like, no. And she was like, every smart business owner leverages a line of credit. It's just it helps you so that in those low months you're not eating ramen, not paying yourself, and then you feel awful about yourself. You can't run your business smartly. Like you need to be able to keep your revenue up. So I just wanted to touch on that because we actually don't talk about it enough on this show. So as you're thinking about your balance sheet, you have bad debt, okay debt, and great debt, right? That can help you. And so I'm glad that we touched on those. Okay, so that was your first financial red flag was the balance sheet, right?
Yep.
Having too much debt. So tell us about the next one.
So the second financial flag is going to be on your income statement, and
Okay.
it's going to be a little bit of a calculation depending on how you pay yourself.
And you said that the income statement is the same as your P&L, right? So if they know it as
Yes,
P&L, same thing. Okay.
same thing. Sorry, income statement's the accounting term, so it's what I default to. But
Okay.
QuickBooks and Xero, a lot of that will usually call it your profit and loss statement, your
Okay.
P&L. The owner's compensation. I'm going to bet almost everyone listening to this is not paying themselves enough.
100% I will agree with you because it's like my mission in life is to make the wedding industry pay themselves enough money.
If you're paying yourself by payroll, it's going to be on your P&L and you'll see it in the payroll. If you are not, then we're going to see it in our balance sheet when
Okay.
we look at equity. In your balance sheet, you have assets, you have liabilities, and then you have this whole section called equity. And
Okay.
that's where the money you've put in and the money you've taken out shows up.
Okay.
And if you're paying yourself through what we call profit distributions, if you are
Okay.
still a sole proprietor, you're running everything through personal taxes, then you're going to take cash out and it's a profit distribution. That will show on your balance sheet. Either way, I want you to take however much money you are paying yourself and compare it to your revenue number.
Okay.
If you are less than 50%, usually is what I like to see clients aim for. If
Okay.
you're less than 50%, then you really want to look at your expenses and
Okay.
the revenue generating expenses.
Okay.
And I don't want everyone to think if I'm not paying myself anything right now, I need to be at 50%.
Right.
That is the goal. If you're not paying yourself anything right now, I don't know if you guys have talked about it on the podcast, but I'm a huge profit first fan. So if you are
Yes.
not paying yourself at all, go set up that profit bank
Yeah.
account and set up 1%. Just start at
Yes.
1%.
Okay.
So when I say 50%, this is that 50% of that kind of net profit generating number.
Okay. That's actually helpful to know because I'm sitting here thinking, I tell my students to have a goal of 30%, but I'm taking it off of gross revenue.
Yes, so I'm sorry, I'm taking that net. So if you have a team, if
Yep.
you have costs that go into generating profit, generating
Yes.
revenue,
Okay.
you want 50% of that net number
Got it.
should be going to you, and the other 50% goes to paying the bills.
I love it. Okay, so that makes sense though because those should be around the same number that we're talking the same dollars
Yes.
here. And so just in case, I always want to make sure that if there's anybody listening and this is just one step above and they're just getting like what's happening, I want to just take it back for a second. So your gross revenue is literally like you sold this much in revenue, right? So it's like I sold
The cash that
$100,000
came
this
in the
year.
door.
Yep, literally the cash that hit your bank account in that time period. Your net revenue is after your expenses, except for yourself, right? After your expenses, that's going to be your net revenue. And what Danielle's talking about is your goal is to pay yourself 50% of that net revenue. Is that correct?
Yes, and when we're saying expenses, we're talking about those revenue generating expenses,
Great.
not
Okay.
the keep the lights on expenses.
Okay. That's helpful to know, actually. Okay. That's great. That's perfect.
So that is the second red flag. That's going to be the big one of, first of all, let's build a habit of paying yourself. If you are not paying yourself, this is where I love profit first. Just build the habit. We are
Yes.
all creative people. If you're running a business, you are smart, you're creative, you know how to think outside of the box. You might just need to challenge yourself to do it.
Yes.
And making sure you pay yourself is a huge part of that.
Oh, that's so good. And yeah, just the habit of it. Just even if it's like Danielle said, if it's a tiny amount of money, it doesn't matter. Just get in the habit of it. And as you grow, it will grow with you, which is amazing. Thankfully, my mom was a business owner before I started my business. And so she really impressed on me that, like, from day one, you have to pay yourself. And it was, I want to say I paid myself like $18,000 for years. And it wasn't much money. It certainly was not much coming into our household, but it got me in the habit from the beginning that I had to make. I was an expense of my business is basically where it was, is that I am an expense. And if I were to get hit by a bus tomorrow, someone would have to get paid to do my jobs.
Yep.
And they're probably not going to do it for 18,000, but at least the habit was there. So what's the third financial red flag?
Okay, so this kind of combines the two that we've talked about. In that equity section of your balance sheet, there's
Yeah.
something we call retained earnings, which
Okay.
represents all the income that's come into your business over time against kind of those liabilities that you owe and the equity that's come out.
Okay.
When you have negative retained earnings,
Okay.
that means that you have paid yourself, you've taken more money out of the business than it
Mhm.
has made over the course of time.
Okay.
So at the very bottom of your balance sheet where you see that retained earnings number, if it's negative, it means in the course of your business, you're actually losing money. Even if you feel
Okay.
like you're paying yourself, even if you feel like you're taking it out, what has almost always happened in that scenario is what I was talking about earlier when someone has gotten an idle loan or some form of debt and they still owe, let's say, $50,000,
Mhm.
but they paid themselves from that. They took the money out. So now you're probably going to show negative $50,000 on that
Yes,
retained earnings if income's just netting out at zero.
that makes sense. That makes sense.
So what I say it last when I say the red flags because you have to understand the other two parts, but it's
Right.
honestly the first thing I look at because if we have negative retained earnings, we
Yeah.
want to see what debt is on the books. How long are you going to be paying? When it comes to those idle loans, and I know, like I said, almost every business owner took some,
Yes.
they are 30-year loans.
Yeah.
And people making minimum payments on a 30-year loan, I always ask, I was like, where do you think you're going to be in 30 years? Where's your business going to? Do you
Right.
still want to be doing this in 30 years?
No.
So then you don't want to be making minimum payments.
That's good to know because I think, let's talk about the idle loans for a second because I think that this has been a topic of conversation a lot amongst my peers, my coaching group, other educators, or other wedding pros as well. Now, everybody took these idle loans. The EIDL loan is what Danielle's referring to. So, not the PPP grant that was forgiven, but the EIDL loans that were given to small business owners during the pandemic to help you survive. And everyone I know that was eligible to take them took them.
And they were pretty
And
easy to get. I
oh,
mean,
they
they weren't
were
hard.
honestly too easy to get because then it became, oh, and do you want more? It's sure. And why not? And I'd love to talk about that because I've heard two schools of thought, right? One of them is or was take out the max they'll let you take out because it's a 3% interest rate. Like you'll never get that kind of cash again from the SBA or whatever. And you can pay on it forever. However, there's also the thought of now how do you exit your business because you've got this huge loan on your books and it is making your business look unhealthy. But because it's only a 3% interest rate, paying it back more than the minimum payment also seems I've heard people say that's just ridiculous. Why would you do that? Why wouldn't you
Yep.
leverage your debt? So can you talk just a little bit about that for anybody who's listening going, Danielle, tell me more.
So this goes back to the theme of our talk today, cash flow. Your cash is probably going to make you more money elsewhere
Okay.
rather than paying extra on your idle loan.
Okay.
3.5% is ridiculously stupid. It's
Yeah.
stupid low right now.
Yeah.
To clean up your balance sheet and have something you can sell and have something that looks better, you need assets that
Mhm.
offset.
Okay.
So whether it's sitting in a high yield savings account, I have clients that would rather put it in a high yield savings account. And we have just mentally said, how fast would you like this paid off to make sure that it's and paid off, meaning like on the books, we look like we're covered to make sure that's there and calculating into how much do we want to start setting aside in a high yield savings account and knowing that it is the whole purpose is that it could pay it off.
Sure.
If
Okay.
interest rates flipped and we were in a position where savings isn't getting anything, now we're
Mm,
paying more for the loan than we are for we want to be able to say, all right, go get rid of it.
true. Okay.
So that's an option using a high yield savings account, making sure whether you do it yourself or you have a financial professional helping you will change how you structure this.
Okay.
Again, profit first in mind. If you're doing this yourself, you probably want a completely separate bank account that you're putting this in.
Very true.
If you have a financial professional that's tracking it for you, they know how
Yeah.
much of this is operational savings versus tax savings
Mm,
versus what we want for your idle loan.
yeah. That makes sense.
You could also say, hey, I want to go put it in the market. A little bit
Mm,
riskier, but depending on your risk tolerance,
sure.
you might want to go put it in the market, put it in a stock or a
Yep.
stock account and investment. And you could be generating 8, 9, 10%
Mm,
versus the 3% you're paying on your idle. What I don't want to see people do is go minimum payment, pay myself, pay my bills, nothing's left,
right.
and you're stuck with this debt for 30 years.
And that can be very overwhelming, not even just that it's sitting on your books, but also because it feels a little bit like shackles. And for anybody that's listening, super transparency. We took the idle loan. I've talked about that multiple times on the show. And what a lot of us did not know when we took the loans was that they aren't transferable. They don't go with your business. They have to be paid off to be able to sell your business, which does put you in a position of, okay, what do I want to do for 30 years? Because while it does make more sense to say, why would I pay more on a 3.5% loan when I can invest it? It also is okay, but now it's there and it's this handcuffs to some degree if you're wanting to exit. So I love the way that you just kind of described that because it really all depends on your situation. You could use your money elsewhere to invest and make it back and then pay it off. So I think that there's lots of schools of thought there, but it's just been so interesting to hear so many people talking about it ever since it entered repayment, right? And so everybody's got their own thoughts on what you should do and how to use it and how to best leverage it.
And how wonderfully clunky and phenomenal it is to deal with their website.
Oh my goodness. I know. It's such a hot train wreck. I'm so glad my husband dealt with all of that and I didn't have to deal with any of it. Okay, Danielle, I love these 3 red flags and I think that they help so much. I will tell you right now, I only look at my balance sheet like once a quarter. I don't know why I hate my balance sheet so much. I just find it not as sexy as the P&L. So I'm constantly looking at the P&L, but the balance sheet, I'm kind of like, all right, it's time to look at it. But I want you to do that wherever you're pulling your reports from. Go pull it, take a look at it, and listen to this episode while you're looking at your numbers. Danielle was very clear about what are red flags, what to look for. So, Danielle, where can everybody connect with you and learn more about what you do?
Yeah, so I'm going to have my team put up a quick web page just so you
Okay.
guys can access it really easy. We'll do the number 4 corner CFO
Okay.
/ wedding pro CEO. So it's easy for you guys to find.
Love it.
And that'll have some really easy options to connect with me if you want. If you have any questions, if you're going through that exercise with your red flags and you're like, I don't know what this means. I love just getting to talk to other business owners and learning more about their challenges and how I can help. And then if you just want to follow on social media, I am on Instagram under 4 Corners CFO. I'm also on Facebook under 4 Corners CFO, or you can follow my personal page on LinkedIn under Danielle Hendon.
Oh, good. Danielle, thank you so much for all of this knowledge and for such tangible, practical tips. I absolutely loved it. You guys go say hi to Danielle. Make sure you tell her you heard her on the Wedding Pro CEO podcast and head over to her webpage for all the ways to connect with her. Danielle, thanks so much for being here.
Thank you so much for having me.